Are there other types of insurance that a lender may have that are not necessarily related just to their loan with the borrower, but just in general?
Yeah, I mean, a couple things. One is just to kind of carry that conveyor belt a little bit further. Let's say the loan goes bad and the lender takes back that property. Then he changes that lender-placed or that borrower's insurance policy to a policy specifically for himself, which we call an REO, real estate owned policy. In a case like that, you now are the owner of the property. So in addition to wanting to protect that structure, you always have the liability exposure that you're now exposed to. If someone gets hurt on that property, falls, you being the owner, if you do take it back at a trust deed sale, then you have a exposure to someone getting hurt on that property, and you need a liability policy. It's also, we have, a wave over the last 10 years or so where a lot of REOs were rehabbed and then sold back to either the previous borrower or a new borrower. And rather than sell them back in a traditional sale, there's been a lot of contract of deed sales that have been taken forth. If you're selling it back to the original borrower or someone else on a contract of deed, then a land contract, then you're going to be required to additionally have an REO policy where you have liability protection because you haven't transferred the ownership. So as long as you have the ownership of the property, then you have a liability exposure. You need to make sure that you're aware of that. The second chapter of this cycle that's gone on the last 10 years where a lot of lenders have taken properties back and they've then decided they're going to fix and flip them and sell them on the marketplace. In a case like that, we have what we call it's a policy where people come in and they do some minor changes, carpets, drapes, flooring, paint, but they're not moving bearing walls or anything like that. Then you need a builder's risk policy to go along with your insurance policy for liability and property coverage.
And in that case where it's just one project that needs some minor cosmetics, does the lender or now the owner of the property, they get a policy that just only lasts until the property sells?
That's correct. Typically, we write those policies for 6-month terms, but they can be canceled in 3 months. Most fix and flippers want to get in and out of the property as quick as possible and sell the property. Sometimes it doesn't go exactly as planned. And then we have the last chapter of that is if you're going to be a hold for rent, and in that case, you're an investor. You're either, maybe you sold that fix and flip to an investor who's just going to rent it out, or you're an investor who's taken back a property, fixed it up, and now you're going to portfolio it. I've got a few of those in my portfolio. And then you need a general OLT, which is owner, landlord, tenant type of policy. So it's a little more inclusive of a liability protection, but the value of the structure is still what you're insuring things for. Again, all insurance gets back to, on the property side, the replacement cost of the structure.